What's up, everybody? Karina Mojica here, back again with another episode of Talk Mortgage to Me. And by popular demand, we're putting Dustin Owen back in the hot seat. But this time, he's answering my questions. You see, I'm at that stage of life where I'm starting to think about buying my first home. So naturally, I did what everyone does. I went online and I started researching. And here's what I found. There are a lot of loan programs out there. FHA, VA, conventional loans, and honestly, it can get confusing pretty fast if you don't know where to start. So today I'm going straight to the expert. I'm going to ask Dustin to break down the real differences between FHA, VA, and conventional home loans. And we're also going to talk about something I see all over the internet. First-time home buyer down payment assistance programs. Are they actually real opportunities or just another internet myth? Let's find out. Dustin, talk mortgage to me.
Karina, I would love to talk mortgage to you, and welcome back everybody to this episode of Talk Mortgage to Me. I am typically not the guy that's in the hot seat. I'm typically the one asking all the questions. However, we've had a lot of fun recently flipping the script, putting me in the hot seat, so let's go at it again. And Karina, I love your questions because these are typical questions that we as lenders get on the daily. I've been at this for 20 plus years. I've helped over 1,000 families obtain financing for their homes, and I never get tired of answering these questions. We'll start with the VA home loan. So a VA home loan for you, Karina, is not going to make sense because you're not a veteran of the armed forces, nor are you active duty military. One of the biggest misconceptions is people think, well, my father served in the military or my mom is a veteran, then I should be able to qualify. No, it doesn't work that way. A VA home loan only works for somebody who themselves is either active duty or they're a qualified veteran. There's a rare carve out that if you're a spouse of a veteran and that veteran is deceased and the veteran is deceased because of something that transpired due to their military involvement, that their benefits would pass on to you. But 20 plus years into that, I have never personally originated a loan, although we have as a company originated a handful over 20 years. So for the most part, you have to be active duty or you have to be a qualified veteran. Now, if you are active duty or qualified veteran, oh my God, it is one of my favorite loan products out there. 100% financing, no monthly mortgage insurance, flexible underwriting criteria. The product itself is absolutely lethal when it comes to helping people leverage debt in order to acquire property to amass wealth. And VA home loans can be done up to well over $1 million loan amount. So it is a loan product that for those that are eligible, it is phenomenal. Now, for people like you, Karina, who are not active duty and you haven't served our country, then we are going to look at an FHA loan and we're going to look at a conventional loan. FHA and conventional loans are similar, but they're not the same. They're similar in the fact that you can get a 15-year fixed and a 30-year fixed, or heck, even a 20-year fixed. They even have adjustable rate mortgages, both under the FHA and the conventional umbrella. Conventional loans has a misconception that they're only for first-time home buyers. That's not the case. You can use an FHA loan to buy your first house. You can sell that house and use an FHA loan to buy your next house. You can sell that and then go use an FHA loan to buy your third home. Now, you cannot use an FHA loan to buy a vacation property. You cannot use an FHA loan to buy an investment property. When you're using an FHA loan, it is for a primary home purchase only. Now, we as lenders love FHA because they only require 3.5% down and they have more flexible underwriting criteria. An example would be if you're putting 3, 5, or even 10% down and your credit score is under 700, more than likely as a lender, I'm going to look at an FHA loan first before I look at a conventional loan. The reason is because conventional loans have what are called loan level pricing adjustments. Think of these as like dings or hits or extra fees you have to pay because your credit score isn't 780, 760, 740, 720, or even 700. We tend to lean into FHA because we like their less restrictive underwriting requirements. Something else that FHA would allow someone to do that maybe conventional wouldn't is if you've had a recent bankruptcy or maybe you've lost a home to foreclosure in the past or you had a short sale, FHA is going to be more lenient than conventional would. Now, an FHA loan, if you're putting 20 or 25% down and you have good credit, we're probably not going to look that way. That's when we would look at conventional. We would look at FHA maybe if you had a higher debt income ratio, because FHA tends to be a little bit more flexible with higher debt income ratios. Some quirks about FHA that doesn't apply to conventional would be this. An FHA loan is going to have both upfront mortgage insurance as well as monthly mortgage insurance. Upfront mortgage insurance is a fee that you are paying to HUD. The HUD is the Department of Housing Urban Development. That's where we get FHA financing from. It's an upfront fee that you're paying because ultimately, if that loan goes into default, then HUD is going to reimburse the lender for its losses. So the way that HUD raises the money to reimburse lenders for their losses would be by charging upfront fees to anyone using an FHA loan. Now, the good news is that upfront fee, it can get rolled into your loan amount. So if you're purchasing a home for, let's say, $300,000, then your upfront fee is going to be between $5,000 and $6,000. The good news is you don't have to pay for that out of pocket. It gets rolled into your loan amount, which makes your monthly payment roughly about $30 more per month. FHA loans do have monthly mortgage insurance, but mortgage insurance is not uncommon. Conventional loans have monthly mortgage insurance as well when you're not putting 20% down. So let's go ahead and talk about conventional loans. Conventional loans are a phenomenal loan product. It's the most standard, vanilla, run-of-the-mill loan we have. 50% of all loans being originated and used today are going to be what we call conventional loans. A conventional loan can be an ARM. It can be a 15-year fix. It can be a 20-year fix. It can even be a 30-year fix, with 30-year being the most popular. Now, when you're looking at a 30-year fixed conventional loan, you are going to be subjected to maximum loan amounts. Just like with FHA, there's a maximum loan size that you can actually borrow. And that loan size changes every single year based on what the average home price is in America. That number is set by the FHFA. The FHFA is the government entity that oversees Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the government-sponsored companies that we as lenders and banks deliver our loans to. They basically create a liquidity facility, meaning if we originate a loan, under their guidelines, they will purchase it from us banks and us lenders. That's really not important for many home buyers to understand, but it is a misconception or something that people are confused about, which is why I shared it. But let's get back on down to the requirements. A conventional loan, back in the day, you needed a minimum of a 620 credit score. That's recently changed, and I actually have friends in the industry that have funded loans using conventional financing with credit scores as low as 550. But in order to get that type of an approval, you do have to run the scenario through Fannie Mae and Freddie Mac's automated underwriting software. And it's that software that's going to look at the total body of the underwrite and make a decision whether or not they're going to grant an exception to go below a 620 credit score. With conventional loans, you can put as little as 3% down, although most tend to put 5 to 10% down. When you're putting 5 to 10% down, or heck, even 3% down, you are going to be asked to pay mortgage insurance. Mortgage insurance is a fee that you pay that protects lenders against you, the homeowner, going into default. If you want to avoid paying mortgage insurance, you can put 20% down, and putting 20% down would allow you to avoid paying mortgage insurance. But please know, mortgage insurance is not a bad thing. A lot of times it makes sense for someone to only put 5 or 10% down, pay the small monthly mortgage insurance premium, because it's actually financially and economically safer to have money in reserve than it is to not be paying mortgage insurance. When you're using conventional financing, it's also important to know that unlike FHA and VA, you can currently use a conventional loan to purchase an Airbnb, a short-term rental, a vacation property, as well as you can use it in order to purchase an investment property. Just know that the riskier the loan, the higher the interest rate. The riskier the loan, the higher the fees. So when your conventional loan is being priced out, you are going to have a worse interest rate and higher fees when you're using that loan for an investment property or a vacation home versus when you're buying it as a primary. And Karina, I believe your last question was talk to you about down payment assistance. Here's what I can tell you about down payment assistance. There are some states that have phenomenal down payment assistance programs. There's other states that they're a little sus, a little 50-50. As the kids would say, it's a little 6-7. So down payment assistance is a great way for certain home buyers to enter into home ownership. However, many down payment assistance programs have eligibility requirements. And I'd hate to see anybody get eligibility confused with approval. Just because you're eligible doesn't mean that you will actually qualify for that home loan. A lot of the eligibility requirements are going to be based around your household income. So you'll hear lenders and banks talk about your AMI. What is your income as compared to the area median income? And there are down payment assistance programs that are phenomenal, but only if you make 80% or less than your area's median income, your AMI. There's other programs that allow you to have 100% of your income is the same as the AMI. And there's even some that allow your income to be 120% higher than your area's median income. You should definitely talk to your bank and your lender about which down payment assistance programs are available if you're a first-time buyer, and better yet, if they're a good fit. Because even though they're available, there are certain home buyers out there that it's not the best loan because there's going to be a better loan program available. But there's some that if it weren't for the down payment assistance program, home ownership probably would not make sense.
Holy shit. That was a lot. I can definitely say I'm a lot more educated, but I'm probably still confused.
Yeah, you know what, Karina? That's totally normal. Like, that was a lot. And by the way, that was probably me scratching the surface of everything I could have shared with you all about FHA, VA, conventional, and down payment assistance. I teach classes to originators about this, and those classes are days long, where we spend hours in the classroom. Here's what I can tell anybody that's looking to borrow money, purchase real estate, or try to get pre-qualified. It's very important that you talk to a trusted lender who comes recommended and sit down with them and let them walk you through your particular scenario, because just like fingerprints and snowflakes, there's no one financial situation that is exactly the same as another. You are unique. Your employment is unique. Your credit is unique. Your assets are unique. Your financial needs, wants, and goals are unique. It's important that you sit down with an expert who can analyze your situation and give you specific advice based on what you qualify for, what you're looking to do, and what's going to help you in the long term.
Perfect. That makes me feel a lot better. Thank you. Make sure to subscribe to the channel, share this episode, and drop your questions in the comments below. And if you're looking to connect with a trusted loan officer or real estate professional, click the link in the description and fill out the quick form. We'll personally connect you with a TLOP-approved professional in your area.
Thanks for coming to hang out, guys. Make sure you click that subscribe button and share this content if you like it.